This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name, as always, is Alex Perny, and today we are very pleased to welcome on Nancy Mullally, CEO and CFO of Alamo Capital. And we're going to be kind of talking about a few different, I'm trying to pose this correctly, a few different topics today that all kind of tie into investing, but I think it's very important to get different perspectives on things. It's one thing we definitely try very hard to do on this podcast. And one thing that is kind of not given enough exposure, I really think, is the female perspective on, whether that is the experience that, women can, expect to, go through within, different avenues of, especially in the financial sector, or just interesting to hear someone who has been doing something that's been such a male dominated industry for so long, I think are important stories to tell. And also certainly centering on, how this can all kind of tie into the perspective that can help you make informed decisions when it comes to investing in any type of asset, but specifically we're going to be focusing on bonds today. I always like to have our guests kind of give their backstory, and especially with you, Nancy, I wouldn't assume to try to give your backstory because I think you could probably give it better than anyone else. So if you wouldn't mind, give us a brief, or give us as much of an introduction as you think is warranted, about you, kind of how, you kind of came to be in your current position, and we'll go from there.
Sure. Way back when, I started work at Merrill Lynch in the back office, learning everything from the back office perspective. Then I went to work for Payne Weber on the municipal bond desk, learned a ton there, worked with the institutional and the traders, and worked on, just how you sell it, why you do it, where it works. And then moved myself up further, went to work for Dean Witter. Now, Merrill, Payne, Dean Witter, those names are all different now, Bank of America, UBS, and Morgan Stanley. So I really got the best of all worlds because I learned from three of the big ones, and they really trained you back then. I was one of the few females on the desk. When I first started, there were maybe, I'm going to say 5 or 6 female traders, and it was really great to be able to meet them and work under them. I sat on all those desks and learned everything I could. And then I got married and had a couple of kids and realized that going all the way to San Francisco every day was probably not in my best interest. So I'd leave at 4 o'clock in the morning and come back at 5 o'clock at night. And having a couple of kids, it made it a little harder. So decided to open up my own investment firm in 1987, became a broker dealer in 1990, and we're in Walnut Creek, California.
Awesome. Great. Well, I think that's definitely, a good kind of primer for everything. And I think any story is kind of best to start at the beginning. What initially drew you into finance, especially in the 70s as being a woman? I think to say that it was a top-heavy, male-dominated industry is maybe putting it a little bit lightly. So what was kind of something that, initially drew you in to that, and specifically to bonds as well? Because I'm sure you kind of, started out, with kind of looking at it, it's more of a broad spectrum, because, even in the 70s, not that it's a ton of time ago in general speaking about talking about the market, but, the amount of different things that people do in the markets, has certainly evolved, but, we still had bonds, we still had options, we still had commodities, straight line stocks, maybe didn't have ETFs, but, there were mutual funds and things back then. What kind of made you gravitate, specifically to bonds at that point?
I like numbers. I like the way they work. I like the debt markets, a little different than the stock market. You basically know what you're going to get into. You have a fixed rate, you have a maturity date, and you find the accounts that it fits for that mold. So you have short-term buyers, you have intermediate buyers, and long-term buyers. They're all different types of accounts, whether it be retail, institutional, insurance companies, money markets, all the above. I liked it because it was very people-centric at that time, very much relationship dominated. And it was a way that when you started, you could see how it went from start to finish. So working on the sales desk, it was selling the product. But then when I moved to the trading desk, it was more of trading and how the numbers worked. And then when I worked to the institutional side, it was to see how the big guys all did it. And then I worked a little bit on underwriting as well. So learning how to package the product, having to give level debt service to the municipality, and working with both sides of the equation.
So really kind of the human aspect of it is really what kind of initially drew you in, and then you found your love of the numbers aspect of it. Is that kind of a fair assessment of what you just said?
Well, I love numbers. I mean, they're great.
Yeah.
And I went to school for apparel arts of all things when I was young, and that was all about angles and how you put everything together.
Okay.
So bonds are kind of similar. It's like how you package the entire project. And you look at it from three different aspects when you're dealing with bonds. You look at the credit aspect, the duration aspect, and the market aspect. So it changes every day. And over the last couple of months, we certainly have had some changes.
Yeah, no, we're definitely going to touch on, kind of the more topical current event stuff here in a minute. But especially coming in, to finance and that perspective, I kind of want to get your thoughts on some things that you learned, especially for being a woman in such a male-dominated industry, which it still has that problem, much to a lesser degree today, but it still certainly was much more pervasive then. What are some things that really kind of helped to hone your kind of attitude and things that helped you be successful while kind of through the lens of the female perspective by, coming into the industry at that point in time, and how it's maybe changed and things that maybe other women can use to help guide them, especially if they're looking to, get into that type of, that sector of finance.
Sure. Couple of things. I think when you get into a firm, it's really finding out how you become part of that team or part of that group and finding your niche within that. And I think that was super important, and especially for a woman, because there weren't a lot of women that were out there and tutelaging you. So you were like, oh, how do I put these pieces together? But really, it was just sitting down and talking to them, becoming friends and coworkers, and figuring out how we could help each other. And I think that was the biggest thing. And I think, nowadays it's a little easier for entry for women, but back then it was a little harder. I think you had to be on your toes. You had to be quick with your answers. You had to do your research. You had to be right. And, it just made you really, really work hard at it. And I think that was probably my background. I mean, it was just learning the people I was working with, learning how to best offset each other. Whether you were going to look at their weaknesses or their strengths and you were just going to build on it, that's kind of what you did.
So again, kind of the lens of collaborative effort more as a competitive one, while still maintaining, obviously, if you want to advance your career, you have to be better than the person sitting next to you, whether a man or a woman. Still maintaining that, but understanding that this stuff doesn't happen in a vacuum. And I think that's a pretty compelling point, even in today's markets and society and corporate structures, that you have to be collaborative. I mean, there certainly are maybe industries that are less collaborative than others. I mean, professional sports, it's maybe kind of a bad example, but again, not everything is necessarily created that. But I think the collaborative aspect is something that I think is missing from a lot of the lens of professionalism today, right? That air of collaborative effort, which is one of the reasons I enjoy where I work so much, is it's a very much a team effort, across departments, across, men and women working very well together. But again, that's certainly, maybe wasn't always the case. But, from that perspective, when, it sounds like you kind of, again, went, had a hand in a few different firms, kind of when you were climbing that corporate ladder. Were there any things that kind of perspectively that made you really want to make those switches? Was it maybe sometimes understanding when there was not necessarily a cultural fit, or was it something where you were mainly looking for what firm would offer you the best ability to focus on what you were really aiming to provide or engage in the markets?
I think I looked at it in both sides of the equation. I looked at what I could do for them and what they could do for me. I believe that having that wider lens was really good. I would go in, I was never afraid to ask a question, and I was never afraid to tell them I didn't know the answer. That's huge, and that's really hard for a lot of people. Everybody wants to know everything, but you can't. These markets are ever evolving, and I don't think any one of us knows 100% the correct answer at any given time. We have a very good direction that we're going, and we have good history that we can pull from. but to be 100% is pretty tough. I'm good at 95.
Yeah, absolutely. And I think that's again a very compelling point is that, and it's something that I try to, you know, be very cognizant of when I'm engaging, especially when I'm the one providing the, expertise on a topic, is not being afraid to say you don't know something, but also making sure that we all frame that in the correct context. It's never good for anyone, whether your position, to say, "Oh, I don't know," and then just leave it at that. Frame it as, I don't know the answer to that, but I will find out the answer for you. And obviously making sure that you follow up and try to figure out to the best of your ability, what the
I
actual
couldn't agree more.
answer to that is. I was just dealing with that with a large amount of ambiguity in the tax code on rollover rules for retirement plans. And me and one of my colleagues are sitting here like reading through the tax code on it and pointing out the how the IRS is not necessarily giving us the correct answer, while also talking to our clients and other interested parties, being like, yeah, trust us, we're trying to figure out the answer, but the IRS is anything but ambiguous on some topics. So, again, don't be afraid to say you don't know something. And I think, again, that's something that I think a lot of people should really take to heart. Trying to figure out that concept of it being okay to not be an expert in everything, but learning how to learn, right? I think is definitely important. So talking about kind of, again, looking at the different levels of bonds, right? You have municipal, you have, agency, governmental bonds, you have all these different places that issue them, whether you're on the sales side or the underwriting side or the analytical side of things. What kind of things help guide you to figuring out where you found the most success? In that, what was the part that really, pulled you in, and where you really kind of found your niche, and how did you flourish in that area?
I think it goes back to that same premise of saying I don't know, and then going to find the answer, and to really look at it from different aspects to find the complete answer. And that helped me along the way, because when you're first starting out, if somebody said, okay, here's a yield book, or here's how you calculate a yield, you don't really know how to do that. You have to learn. And it's mathematical, and it's something that you have to put all pieces of the equation together. It was hands-on learning and asking the questions and having the ability when asked, another question from somebody else to say, I don't know, but I will find out that answer. And then finding it out and then putting all the pieces of the puzzle together. That's huge. A lot of people may only know one aspect of things, and it's good to have a broad overview, but you can't be an expert in everything. And knowing your limitations, I think, is huge.
Gotcha. And would you say that there is a mixture of kind of the self-determination aspect of that, or how often, at least when you were trying to, build your career, did you find it more advantageous to have someone that was more in a mentorship role to you? And then also, if there was mentorship that went on, how did you best approach that and try to, gain the confidence of someone to invest their time to teach you what you needed to know?
Reaching out across the aisle. You have to ask. You have to ask for the help. It's not going to just come your way, and you can't expect somebody to stop, drop, and roll and give you all the answers. You have to have a working relationship that you can reach out and say, I don't understand that. Could you just take a minute and explain it to me? And then give them another example to make sure you understand it correctly. Put it in another content. So that to me is how I was able to learn more and get people to sit down with me and say, okay, this is kind of how you're looking at it, this is how I'm looking at it, but we think maybe this is probably more right than that. And it's also picking up on a municipal bond, you get an official statement. Picking it up and read it. It might be 200 pages, but when you pick it up and you learn how the indenture is and what the source of revenues are and where the payments are coming from and how often they're going to be made and who's the working part and what the revenue source, or if it's a tax source, how you put that all together. And taking the book and reading it, really, that opened my eyes. All of it did. One of the things that I did was I worked on a variable rate demand note desk, which is every 7 days you change the interest rate and there's a put there. That was very interesting because each one of those municipalities had a different indenture, and you had to read it and you had to know exactly what the nuances were. whether it was 30 over 360, which is how many days you would get your interest payments, or if it was actual over actual days in the year versus. And you had to calculate all that. It was awesome to pick them up and then put a grid together and kind of understand it and then become maybe the master of that tool.
Great. No, I think that's very important. Now, from the perspective of being a woman in that, time period, are there any kind of things besides just, exactly what you just said of don't being not being afraid to reach out? And I think that a lot of people, again, whether you're a man or woman, I think that first step in reaching out is tough for anyone, no
Yep.
matter who you are. But specifically, again, I make no assumptions. I always try to be careful, especially when for one, I'm not a woman, so I only have my male perspective. But, again, take this, and run with it the way you want to, but are there anything that's specific to what you feel like women specifically need to know on that? Because I would assume that maybe it's a little bit more just daunting for some women, especially in male dominated industries, to even reach out for that first thing. Or is it just kind of getting rid of that fear and understanding that everyone's in the same job, trying to get to the same place, trying to put food on the table? But specifically from your perspective on that, do you think there's some good points that women can really take away from that to help them in that endeavor?
Yes, I think the biggest thing is don't ever let anyone intimidate you. Know that you're a person, they're a person. They walk the same way, they talk the same way. It's just you just have to understand that they're a person on the other side. And if they are intimidating, that's okay. Just figure it out. How you are not going to let them intimidate you, and how to converse with that person. That was probably the hardest part when you're young. You're sitting there thinking, "Oh, I'm calling this person, and they handle billions of dollars in investments. Why are they going to talk to me?" Well, I had value added, and I needed to know that, and I needed to break down that barrier of saying, "No, I'm not intimidated to talk to you. I know what I'm talking about," and stand up and make sure that you were heard. And that's in a kind way, always a kind way. Always find out how you can converse with them. I think when I was doing a lot of the institutional, it was great because I became friends, and then I found out, they were married and they had kids and their family and what they did, what their hobbies were, and I wrote them all down and I would remember them. Then when I would call them again, it was a lot easier to make that phone call. So commonalities, find them.
Yeah, exactly. I mean, I think kindness and I'm trying to think of the word right now, but just engagement. A level of caring will go so far in any capacity of just understanding again that everyone's human and you'll run into jerks. Not everyone can be satiated by just kind of adhering to best practices. You're going to run into people that are just abrasive and crass in your life, right? But kind of understanding that being able to again have some compassion and genuine interest in the other person on the other line will probably yield significantly better results. Now, were there ever any times that you kind of experienced a point in which hey, look, this person's being just obtuse, abrasive, or just is I'm better off either not engaging or kind of when that might be a sign of like when you're not getting through and you need to kind of either shift gears and go to someone else or change your tact.
Yes, you always have to do that no matter what you do in business. You have to figure out a way to engage and to be able to communicate. So I would write little notes to myself if I was intimidated to get on that phone call, and I would say babies need new shoes when the kids were younger, and that would just make me get on the phone and do it and listen to them. If they were abrasive, you could just maybe tone it down by giving them a nice compliment or finding a way to calm down the situation. And I think all of us try and find that in life. So it's a balance. It's like a work-life balance. Figure it all in, put it in there, because the bigger the mix, the better.
No, absolutely. Now, kind of moving into a little bit on the asset side of things, and again, I'd love to kind of get your perspective on this. But what do you feel is kind of one of the biggest missed opportunities for most investors when it comes to looking at bonds in general? And do you feel like there's one type of investor profile that either should be looking at them or just in things that people kind of typically get wrong when it comes to thinking about bonds? Because most of the people, at least in my age bracket or the people that I engage with think bonds are just kind of boring, right? I hate to, I'm not saying that I necessarily think that, but again, that's, a general sentiment of a lot of stuff that I operate in, especially with people that, are engaged in private stock and real estate, digital assets and things. You say bonds and they're like, I think my grandfather owns some. Maybe there's some in my pension. I don't know. But again, that kind of thing of what people should really be, taking to heart, and what kind of people should maybe be looking at bonds with a little bit closer lens.
Well, I think the first thing is you have to demystify them. Some people say bonds, what are they? How do they work? And different bonds are going to have different types of credits. Let's talk about the government bonds. Government bonds are pretty secure because they are backed by the government. And you may have IRAs that want to have short-term money markets. They might have intermediate needs for funding their liabilities, which is what you do in retirement, right? You're funding a future liability. So you may have somebody that's 80 that only wants to go out 5 years, but they want to have some safety and security because they have alternate investments and they just want to balance the portfolio. It's a great way to do that. So I would say, on the government side, it's the credit, because it's the U.S. government. It's the duration that you have to know which one works for you. And then it's basically the markets when you want to buy. A few months back when we had the inverted yield curve and you could get a 5%, or a year ago, when you get a 5% on a T-bill, that was pretty attractive for a lot of people versus going into a money market or trying to do their own little money market and buying or dividend paying stocks. 5% was pretty decent. So you had a lot of people that were in the short end. You still have them in the short end, but they're only getting in the 4% handle now. So then maybe the 2 to 7 year would be a little bit more intermediate type buyer. Maybe want to go out a little longer to generally get more yield, but they haven't really been getting more yield because we had an inverted yield curve. So that area of the scale was just basically picking things that would fit within a ladder or would fit a spot that you knew that you needed to have duration that would fit that. Long term is always yield. It's the yield buyer that wants the income. They want to get the highest yield. But again, when you have a 2-year at a 3.65 and a 30-year at a 4.64, you're really not getting that much spread for going out another 28 years. So it really depends on the buyer. The buyer, if they have a need for going longer and they think that interest rates are going to come down, they'll buy longer, wait for them to come down, and maybe sell that asset and buy something else that they could use that money with.
Gotcha. So again, just the high level is kind of looking at, hey, what's the, period of the loan? How long is this thing spread out? Is it, and are they kind of, are they blocked off, or do they kind of, or can they be like as minute as you want, or do they typically like get bound by like a year, 2 year, 5 year? Like what's the typical term of most bonds that people look at on the general market?
Well, I think the 2, 5, 10, and 30 are going to be your big ones that people look at. And then you're going to know the buyers that it fits better for their portfolios. 2 years, you're going to have retail, you're going to have institutional because they only have so much of a horizon and they want to make sure that matures. And remember, if you build a portfolio and then you do a laddering, so you buy different bonds that mature in different months or different years, then you use that money when it comes due in a then current market. The then current market could be higher, it could be lower. And then you can make your guesstimate of where you'd want your investment that fits your need at that time.
Sure. Yeah, and from the perspective of, face value pricing, what are some big factors that kind of affect that? Because, bonds are not always just necessarily, newly issued. There's a discount that can be, or a discount or a premium that's built in depending on what you're buying. So at a high level, kind of maybe explain that to people, thinking of, they, think about going and buying a bond, but you're essentially buying a debt instrument, right? You're, the person on the other end of that's agreeing to repay for a certain amount of time with a certain interest rate, and there's a maturity date, right? It's, basically just kind of like if you think about your home mortgage, it's issuing on good faith of a certain entity to provide payment on that. So maybe talk a little bit about maybe in what market factors can affect current pricing. Is it all pegged on just what the Fed's doing with the money rates, or are there other things that affect the current acquisition pricing of bonds?
Well, there's a lot of things that affect it. We have, as I said, you have market risk, you have credit risk, you have maturity date risk or duration risk. But let's bring in the fourth one that's probably been in the forefront for the last couple months. Political risk. We have tariffs. We have fears that we might have inflation. We have fears that we might have deflation. We have fears out there that maybe we should have the Fed cutting rates versus versus keeping them where they are at, because you may have some pressure coming in because the dollar's down and you have people that are hurting, right? So they want mortgage rates to go down. They want people to be able to buy homes. So you have a political risk that comes in there, and it's always there. It's just a different story, a different day. So if you're buying long bonds, then you're locking in that yield, and you know that you're probably going to have most risk out there on the longer you go, because the duration is part of that risk factor. So if you buy a 30-year bond and the market moves 25 basis points, you could be down 2 or 3 or 4 points, depending on maturity. So it is something you definitely want to be comfortable with when you lock in a longer term investment, because most people, individuals, will buy it with a buy and hold versus institutions that are buying it because they're putting in their economist is looking at what's going to happen down the line, and they think they might make more money if they go longer, or they might make more money if they stay short. It just depends on it.
Now, let's talk a little bit about and kind of touch on it right here, is that, risk can be based, the things that people look at a lot, are going to be the issuer and the credit risk, right? And I think those kind of typically are going to fall into, who is issuing them, right? I think would it be fair to say that the farther down the stack you go, coming from the government at the top all the way down to the, smaller cap people that are issuing these, that your risk increases to that point? So maybe talk a little bit about, how these things are kind of packaged together, right? It's either going to, like, who are the people that are typically going to be issuing bonds that the general public can engage with to invest in?
So we just talked about government bonds. So we'll go to the next one, which is agencies. They're agencies of the United States government. So agencies will issue bonds as well, but government's bond will be the most secure. Then agencies will have a little bit more risk. And then you can go to municipals, which are cities, states, counties, townships, etc. And then you could go to corporate. And then you could go to preferred, then you can go to stocks, and then you can go to warrants, right? So it's kind of, one is the high end of the security scale, and the other one is a little lower end. But if you have a balanced portfolio, you're probably going to have all of them. It just depends on how much you have of them. The older you get, probably the more you would lean towards bonds, because you'd be more of a fixed income and you'd want to know exactly what your income is going to be. The younger you are and the more risk you can take, you'd probably be on the other spectrum where you're looking at private equity, maybe getting into the real estate market, stocks to start your Roth IRA or your regular IRA or your regular account. And then you could go into the preferreds and munis and corporates and treasuries. Munis have a charm that others don't, because they are tax-free on both the state and federal level, depending on the state. So I'm in California. We have a high state tax. So if you buy a bond that's like a 5% coupon, you get that 5% coupon. You don't pay any taxes on it, but it depends on what your tax bracket is. And if your tax bracket is quite high on both the state and the federal, you could end up having a 7.5% yield on a 5% coupon. Just depends on what your total tax bracket is. So it's a taxable equivalent yield that we work with and we show to the customers so that they can take that taxable equivalent yield, then look at corporates and treasuries and agencies and see if they're beating them or not. Right now, munis are fairly attractive in the market. And we also have taxable munis, because with the laws that have changed for the IRS, you can only do so much when you are a municipality. And if you have anything that goes out of that range, then you're going to have to do it on a taxable basis. If you're in a state that is a high state tax, like California, California will not tax them, but the federal will. So then it puts them on a different playing field with a corporate bond, because a corporate bond is going to be taxable on both.
Yeah.
Does that help? I mean, it's a balance that you have to play. And it also depends on what type of account you're putting it in.
Yeah.
Municipals generally would not go into an IRA because they are tax-free. And if they can beat a taxable on a straight-up basis, maybe. But you would probably put a taxable municipal in to an IRA before you would put a tax-free.
Yeah, exactly. There's a lot of different variety when it comes to bonds. Now, to touch on one more last thing on risk, just because it kind of popped in my mind. Mm-hmm. At what point do default risks start to really become a concern in the risk profile of these, not just, the time horizon and the interest and the market factors, but, I'm just not much of a, and again, I'm sure there's people, especially in today's, current political climate that would say otherwise, but, you really don't have much of a risk of the U.S. government defaulting on a federally issued bond. But the farther down that stack you go, I mean, towns have gone bankrupt. There's different things that have happened. Companies can go away, right? So at what point does that risk profile really start to kind of edge in? I mean, we should always be concerned about it. I mean, the Roman Empire never thought it was going to fall, but look at that. So, again, just hedging that risk again with what's likely to not happen, but what is maybe possibly going to happen. Where does that kind of start to rear its head?
Well, I think over the last couple of months, we probably had a little bit of a fear only because we had the unknown. And people, when we have an unknown factor, and the unknown factor was tariffs and trade wars and, trade imbalance and, the rhetoric that was happening, there was a lot of fear. Fear plays a very, very different game into into any of the fixed income markets. Because once you're afraid, it's like, you make decisions that are probably not the best. You need to really look at it and look at it from different perspectives. But fear in the marketplace generally used to say, okay, we're going to have lower yields in bonds because there's fear and the equity market will go down, the bond price will go up, but the bond yields will go down. That didn't happen over the last couple of months. And it didn't happen because we were all in sync, because we were all so afraid because we didn't know what was going to happen. And same thing happened during COVID. Same thing happened in 2008 when we had the banking crisis. Anytime you have fear in a bond market, it really can be detrimental. And we did see swings. We got close to a 5% on the 30-year. Today we're at a 4.65. 35 basis points is a pretty big move, especially on the 30-year. 10-year, I think, got close to a 5, and the 10-year is like a 4.17 now. So that's a pretty big move as well.
Yeah, it's definitely kind of interesting to look at what affects bond markets, because again, it's something I will say I am woefully ignorant of as much as I probably should understand, especially for being in finance for as long as I have been. But again, just kind of we all kind of get in our lane and understand very well what we're task in front of us every day. But again, kind of going back to your, your point of, learning, right? Asking questions, being engaging with stuff that you find interesting, because you never know where that particular opportunity is going to help to drive you, right? You might be super interested in bonds, but be sitting on an options desk. Well, okay, well, maybe I should look at bonds because it's definitely an avenue that I can explore and be successful in. Now, when it comes to, again, bonds in general, are the issuance, is there a timing factor of when, obviously, market conditions will affect the secondary market price? I think that's easy enough for people to understand, but is there a benefit or kind of a calculated strategy of trying to buy at an issuance and like an initial issuance offering of a bond versus waiting on a secondary market and just playing in that? Or is there really any truth to what I just said, or am I hitting on something, or am I missing the mark on that?
It depends on the market. Governments are going to trade pretty tight. You're going to have different yields and different coupons and maturities, but they're going to trade pretty close to where the new issuance is, and they're going to be based off of that. Corporates the same way, but remember, we're going to look at credit quality. So in treasuries, we don't really have to worry about that because they're all the same. They come from the same bucket. But a corporate bond, you're going to look at the rating. Rating can range anywhere from non-rated all the way up to AAA. So AAA, is thought of that would be less risk than a non-rated bond. So it depends on what your investment parameters are and how you are going to look at it for your whole portfolio. Not everybody should buy below a triple B because that's non-investment grade. But that doesn't mean you can't buy it if you know the company, if you've done the research and you understand it, and you are more of a sophisticated buyer. But if you buy a A-rated bond, does that mean it's a bad bond? No, it doesn't mean it's a bad bond. It just means that it's in the A-rated category. So you take a look at, as I said, you've got 3 major factors, well, actually 4, but it's going to be credit quality, duration, and market risk. And then let's leave the political risk out, but it is definitely there. So when you're looking at the rating, that's going to be part of your credit risk. So if you have A-rated bonds, and you have stocks and you have real estate, that's probably a good balanced portfolio because it's in the middle of the pack. If you had non-rated bonds and a ton of alternative investment and no real estate, it's probably more on the risk side. So you have to figure out where your risk is. And if you look at a lifestyle investing, which is going to be age-based, you're probably going to say, okay, if I'm 60 years old, maybe I should have 60% of my portfolio in something that's a fixed income, 40% in other investments. Or if I'm 80 years old, should I have 80% in bonds? It's not perfect, but it kind of gives you an idea. So it really depends on your investment risk and your investment tolerance, because risk and tolerance are kind of two different things. You could have somebody that's way out on the risk basis, but they can tolerate that risk. If you can't sleep at night, you probably shouldn't be in that investment.
That's a good point. Or if you don't understand it, I would add that to that. If you don't intimately understand something, especially on the the higher risk profile side of things, again, take a breath. It's investing in things that are very, again, security is a very it's kind of a bad term in a lot of use cases. It's what is security, right? It means different things to everyone else. But again, a bond issued by the federal government, again, you don't have to do much thinking on it, right? The United States government's going to pay their debts. Heck, they'll print money to pay them. That might cause a lot of inflation. You have to worry about other things, but again, they're going to pay that obligation. So when it comes to credit rating, and this is something that I personally don't understand, that I'd like to get kind of the experts kind of guidance on, is that I understand a lot of things on risk on a lot of different assets, right? The riskier something is, typically the more potential upside there is, right? Whether you're lending, especially in real estate, right? If you have a borrower that needs money, maybe they have some defaults, or maybe it's a speculative property development, you can charge more interest, right? You can get a higher return, but you have a higher risk profile for that. So where does the reward portion of the equation come into play on the riskier end of the bond spectrum as it relates to credit rating, right? So if you're going into something that is, A or lower, where does that additional juice come in to make it an attractive option for weighing that risk profile?
Well, they all have like a spread, right? So if you've got an A-rated bond, it may have a 50 basis point spread off of a AAA, right? So AAA will be 50 basis points lower in yield than an A. And then if you go to a non-rated, depending on the credit, depending on what the revenue source is, you could be up to 200, 300 basis points. There's just a lot more risk because you haven't had somebody assess it, run all the numbers, put all their calculations together with their models, and come up and give you a rating. Does it mean that you should never buy non-rated bonds? Depends on your risk tolerance. But there are bonds that are out there that are non-rated, and it could be because they're very small issues, and they're fine. But it just depends on what your risk tolerance is and who you're working with and how you understand them. Understanding is huge. So let's talk about an item I saw in one of your podcasts, mobile homes. Mm-hmm. So mobile home parks can be owned by a 501c3, which is they are a tax-free entity, right? So they could go to a conduit investor and they could refinance or finance a mobile home park. Why would you want to do that? Well, because cities, states, counties need to provide low to moderate income housing. So they will work with the entity, but what do they have to put in for a mobile home park? They have to put the utilities, they have to put the road, they have to put maybe a clubhouse, maybe a swimming pool, and they have to put fences around it, and they have to have somebody maintain it. But then you get all the coaches that come in, people own those, and they rent the space for the coach. And basically, it's just a revenue source, and they're generally pretty good revenues. So you could have a mobile home park that is municipal bond, that is tax-free. We just had some in inventory the other day, and they were 5% A-rated or A- rated. And that was really attractive because they were 5.25% yield. So it was pretty neat to see it, but understanding how all those revenues come to be and being able to explain it to your customer and say, this is the revenue, this is the coverage on them, and this is the rating. So you give them all the information and they can make up the decision if they want to buy it. I think mobile home parks are pretty good cash flow. So that's what you want to look at. You want to know the ability of the borrower to pay you back. And that's what the rating kind of gives you, a guide of what their ability is to pay you back.
Yeah, and I think that's also kind of an interesting avenue too, to kind of bring the bond market, especially for our listeners, into a little bit more perspective, because a lot of people in our audience generally are very very sensitive to cash flow. It's a big metric that people really like, and obviously real estate is probably three-quarters of our AUM here at Advanta. On the professional side of what we do, real estate and real estate related, right? The full stack from direct real estate ownership to limited partnerships, private trust debt, all that kind of stuff. So, understanding the constituent pieces of the puzzle that drive cash flow that help to pay debts when, it's not the government that, no pun intended, but does have a cash printing machine, to be able to pay those debts, right? It's a benefit of the government, like, oh, click, we have more money now, we'll pay these debts. So again, that's really interesting, and for as much as I know about mobile home investing, I don't get into the parks too much, at least with my clients and where my expertise lie. But it's really interesting that they can qualify under 501c3 status for being able to get in there to do municipal bond issuances for that kind of stuff. That's really interesting. I always love to learn from my guests, not on just a high analytical level, but on a practical level too. That's really really interesting. Now, from the perspective of getting kind of the ultimate risk when it comes to default, sorry, back up one step. The question that I wanted to ask before that was when it comes to the stack of investing, right? I would assume, just like with traditional securities, there is a high degree of transference and quote unquote liquidity in the market of your AAA rated government bonds, to where if you own one, you can readily sell it, right? You can click sell on a profile. But just as I would imagine with anything, as the risk profile ramps up, or there's just less of it out there and there's less trading frequency, there's not as much of a market. So what kind of exit strategy is there, or is it kind of, again, to get into the the term pink sheets, is it just not necessarily always something that has a market maker behind it to buy some of these things when you get farther down the stack?
I think there is something to be said there. Let's take the municipal market for example. If you had a higher yielding, lower rated bond, and you only have so many players that understand that bond, you may have more of a limited market. But if you had a state of California general obligation bond, State of California general obligation is an ad valorem taxing power for the state of California. They can raise taxes to meet debt service. Simply said, that is exactly what the terminology is. So that would trade on a much tighter level and probably always have a bid in the market. Where you might have a non-rated senior housing facility that has a very limited market, it may be difficult to get a bid on that. And you may have more of a default risk because the cash flow depends on what's going on in the marketplace. So again, you got to look at the whole big picture. But I think what we just went through for the last 3 or 4 months, with yields backing up and then getting tighter again and then backing up, it was basically on news. So if you had news hit, it would sell off, and then if you had the news that would hit was positive, it would come back. And you had the same thing with stocks. We were kind of trading in tandem. It felt like a swing or a teeter-totter. We would go up, we'd go down, we'd go up, go down. You're going to have those kind of markets. And those kind of markets is not a type of market to panic in. It's to say, am I comfortable holding this investment? Am I okay with everything that's going on in the marketplace? Or do I have to stop and sell it all and get out of it? It really was pretty tedious, but we did see that, there was some liquidity issues in the market, but weren't big issues. I mean, government always got a bid. Most corporates got a bid. Most municipals got a bid. It just got a wider spread.
Yeah. And to that point too, is there kind of the traditional market maker profile that people are used to in kind of traditional stocks with these things, or is it always going to be point counterpoint, or is there kind of an intermediary market maker for these, or is it kind of just like you said, depending on the type of issuance that you're looking to do, whether it's government agency or municipal, the farther down the stack you go, the less there is that kind of intermediary.
Well, you have regional trading desks, you have major trading desks. All of them were out there. All of them trade every day. So they were bidding on where they felt the market was. They were offering where they felt the market was. It's just the swings were pretty big. And then, you could buy something one day and then it could be down 2 points the next day. Then the next day it could be up 2 points or 3 points. That's what was happening in the last couple months. Only because the biggest problem was fear. No one knew what was going to happen. And when you have so much turmoil out there, that people just get scared and they make decisions based on the fear. And sometimes that's not the best way to do it. Now, does it mean that all markets are like that? No. We've probably had, I'm going to say in my time in the industry from the late 70s to now, maybe 5 major cycles. And, then you just didn't know what was going to happen. A lot of it is also with the Fed action. When the Fed is meeting and they are talking about raising interest rates because we have inflation, you're going to have probably a wider spread market, and it's probably going to be one that yields go up, dollar price goes down on bonds. When the Fed is talking about, geez, we've got all this under control and we need to ease and we need to cut interest rates, then you're going to see rapid moves where the market's going to go, dollar price is going to go up, yields are going to go down. So we have an inverse relationship in the bond market. And not to say that's bad, it's great, because yields are what you want to look at. When you lock it in, what you see is what you get. That's what you locked it in for. And if you hold it to maturity, that's what you're going to get back.
Yeah, and to that additional point too, and again, if I'm missing this, because again, I am not the bond expert by any means, but were you kind of indicating that the trajectory of the bond and stock markets are rarely directly correlated, like ups and downs? Normally, it's a little bit more of an inverse relationship to the two markets, correct? And right now, what we're seeing is excuse me, is more of a direct correlation, which is a anomaly. Am I understanding you correct on that?
Yes. Over the last couple of months, that's what we've seen. Because
Okay.
again, the one thing you can't ever quantify is fear. Because when people are fearful, they are going to do different things than when they're not. So when you get fear in the marketplace, you will get less buyers. So since we are, basically an economy that is looking for supply and demand, you have supply build and demand wane. That means you're probably going to have higher yields. If you have less supply and demand is up, you're going to have lower yields. But right in that whole tandem, the whole swing in the teeter-totter was kind of going together, where the Dow and the S&P were down, the bond market was down. You didn't have the flight to quality. I think we've kind of come back to where we're more stable, and I'm feeling like there's more equilibrium there, even though today the Dow was up and the bonds are up, so we're in tandem again. But it wasn't from fear, it was because we had positive news.
Yeah, which again, I think we all could use some positive news in today's economy. It certainly wouldn't be a bad thing. But looking back historically a little bit, again, with your wealth of knowledge and having gone through so many different market cycles, whether it was savings and loan, the first Gulf War, dot-com bubble, the Great Financial Crisis, COVID, all these different things that injected a lot of fear into the market. Is it mainly kind of when you see these direct rise and fall correlations between bonds and securities, are those kind of, again, the genesis of those being those kind of major financial crises that kind of have like just a general tying of those two markets, and then they kind of start to diverge again, like if stocks are going down, the bonds go up, but they have kind of an initial like equilibrium of flux? Or is there something else that kind of plays into that?
Well, each one is going to be different, but I would say the major ones. So when we had the dot-com, and then we have the banking crisis, and then we have COVID, those were all pretty much an immediately drop off and then eventually come back. And they were in tandem. Also, when you start to see inverted yield curves and you have inflationary risks, those are other things that are also going to be more tied to the bond market. Yes, you're going to see them in the stock market, but you're going to really see them in the bond market. Bond market does not like inflation.
Yeah, and again, that's again tying that back into there. So I would assume that with inflation, then you maybe have people looking at more towards the short term than the long term, or would it be the opposite? People looking to ride it out versus people that are saying, hey, the short term one's going to get hammered by inflation. Is that
okay? The short one, you buy it for a short duration, you ride it out, then you go into the then current market. So what you're doing is you're leveling your risk, because you're only going to be in it for a short period of time. So you accept the yield that you have and you write it out and you go on. If you were in the longer end and you had major fluctuation in the market, you may get a little bit more concerned because we're talking about the market going down, but what about when the market goes up? I mean, when dollar price goes up, yields go down. So you could have a market that you had inflation, all of a sudden the inflation dissipates, and then you're back to a normal market, and the yield goes down, but the dollar price goes way up. You're a winner then, so you're going to be happy to buy it when it's down, and then wait till it goes back up. And the opposite is true. When you buy it and it goes down, you're going to be sad because it went down, but you need to understand why it went down. It's generally because we've either had a pretty good economy or maybe we run into a bad economy. They're all intertwined. And that's what you have to know what your triggers are, what's going to move the markets. And the longer you go out, the more you should know.
No, absolutely. And the kind of the last segment that I really want to cover before we wrap this up would be we're primarily talking about the U.S. markets right here. Do you ever get outside of the scope of the U.S. bond market? Do you trade or examine stuff internationally, whether it be like Japanese or British issued bonds? Is there anything that you would speak to that on, or is it something that you just kind of primarily focus on the U.S. bond market?
Well, now we're primarily focused on the U.S. bond market, but we have in other time frames. We've worked on bonds, Argentina bonds, in even the German and Japanese bonds. But you have to look at each one of them and what their economy is doing. And with international, you have another layer of a mix because you have to put the foreign currency along with the foreign bond and what's going on over there. So you really need to know what you're doing when you're doing the foreign bond.
Yeah, absolutely. Because it's not just the US dollar, it's their economy versus their currency.
Right.
And then maybe they have a multinational currency, kind of like the euro or something. So
Mhm.
it's not just, Great Britain's, pound sterling. There's, what's going on in Germany can affect what's going on in Italy, which is affected by what's going on
Right.
in Spain. Yeah. So again, that's just something I figured I'd ask because it's, again, worth looking at. If things are going so bad in the U.S., maybe they're going better in other places. But the problem with such a economy of scale that we have in the United States, being the largest, whichever way you want to play it, largest economy in the world, it does tend to, if we're doing bad, it draws down other economies as well. So it's not as insulary. If you were someone in Greece in the early aughts, buying foreign bonds might have been very attractive, as opposed to, if you're in the U.S., if we're doing bad, and everyone else is probably not doing exceedingly well. Um,
You just really need to know those markets. So you have to look at their currency and what's going on in their market.
yeah,
Yeah, there were times where there were some pretty attractive yields.
yeah.
But today it's more, if you're in the United States, you're pretty much doing your U.S. bond.
Yeah, and again, to understanding, risk profiles, bonds are complicated enough in the United States for everything. Again, by just how much I'm learning talking to you, let alone trying to take into everything else geopolitically and domestically in that country that you're buying in. So maybe leave that one until you have a few years of bond investing under your belt, so you start branching out and into other countries. I encourage people to travel, but maybe to leave the foreign investing to a few years under your belt with that. Now, again, we've had a kind of a great trajectory of this conversation. Love kind of starting out with getting your perspective on everything, especially from the female perspective of starting in finance in the '70s, and then kind of how you've matriculated up into your core business now with focusing on bonds and how you operate in them. Two questions to kind of end this off. From your perspective as a woman who has worked her entire career in finance over many decades, for women that are kind of maybe looking at finance as a career path, or maybe they're in there, they're hitting some roadblocks. What are some things that you can that you would speak to if you were gonna speak to that woman that's saying, hey, I'm having X, Y, or Z problems, whether it be communication or good cultural fit, things that you really think would be good to hear from you as someone who has experienced it and gone through it and overcome some of those challenges.
I think the biggest thing is be true to yourself. Know your value and know what you do and do it well. Those are the things I would tell anyone that came to me and asked me that question. I think everybody can learn something new every day. I learn something new every day, whether it's in bonds or in life, right? So none of us have 100% of the answers, but just know your value, know what you can do, and go do it.
Awesome. Yeah. Again, I think that's important for everyone, especially women in finances, is understanding your value. And if you're not getting the reciprocal of something, there are other firms out there. Where you're at, not where you have to end up, right? And I think you've kind
That's
of
right.
are a great example of that with how many different firms that you worked at, including the one that you're currently heading up now. You don't have to stay in one place. There will be a good fit that will appreciate and take in the value that you have to add to that. And then to our conversation on bond markets and all the different kind of things. I could talk to you for hours. I really enjoying talking to you about that. But at least when it comes to the immediacy of the bond market, what would be some things that you would kind of say to people, especially now? Because I don't think the turmoil is going to get much better politically in our country. No matter what side of the aisle you on, it's divisive, and tumultuous to say the least. But what would you kind of say to people if that they are either looking to get into bonds, or they are a heavy bond investor, of some things that you would say, hey, look, um, you know, some things to look at, some things to be concerned about. But what would you say to the general bond investing populace?
Everybody's going to be different because they're all going to have their own perspective. But I would say that if you've been a bond buyer for a long time and you have a portfolio, just evaluate it, see where you're at, see if you feel like you're too heavily weighted on the long end, if you want to get a little shorter, or maybe what we tell a lot of people is when they're building a bond portfolio, build a laddered portfolio so that you have bonds that are short, intermediate, and long. And as the short comes due, you can take advantage of the longer market, or maybe even weight it a little bit more in the intermediate market. And, if you're doing it with a professional, talk to your professional, ask them questions, ask them what they think is going on with the market, ask them for their opinion. At this point, no one has a crystal ball. We can't see exactly where it's going to go. But the United States economy is a very big economy, and our jobs are still doing well, and the economy is doing okay. Yes, we are going through a bumpy road, but many times we come out of those bumpy roads and we're okay. But
Yeah.
talk to someone, have them look at it, have them give you some suggestions. If you're afraid, definitely pick up the phone and call your advisor. Don't sit there and wait for your statement to come in and panic. That's not the best thing
Yeah.
to do. Have communication.
Yeah, I wholly encourage people that with the information age, it's so easy to either read an article or listen to a soundbite.
Mhm.
But I think the biggest value that people overlook in today's economy, investor circles, whatever it is picking up the phone and calling or talking to someone that is an expert in that field. Is that human component, right? Talk to people
Right.
that have understood this, that have been doing it for as long as you have, that have the experience to have seen things like this. Again, this is a little bit more uncharted territory, but have seen things in tumultuous markets that can help to guide you and understand, what your goals are, what you need to be aware of, and how to navigate that effectively. I think is something that everyone can take a very, heed that lesson very well. So again, if people are interested in, engaging with your firm, or kind of, getting more engaged in the bond market, how can they reach out to your outfit? What's the best way to reach out to y'all?
They can go on our webpage, www.alamocapital.com. They could call us. Our number is 925-472-5700. We have an 800 number as well. It's on our webpage. So just pick up the phone, give us a call. We have advisors that are here, and they will sit there and they will talk to you. And we don't expect everybody to open an account on the first call, but if you have questions and if you really want to learn more about bonds, give us a holler. Reach out.
Yep. Absolutely. I highly encourage, I think my joy in talking to someone like you that's such an expert in your field. I hope that comes across, because I really do genuinely enjoy talking to people that have as much expertise and experience as you do, Nancy. It's been a real pleasure. So again, I encourage you, if you want to learn more about bonds, don't call me. I am an expert in a lot of things, but bonds, I am woefully ignorant. So I will put that cap on. But again, give Nancy a ring. I'm sure they can help you out, kind of get to know what you are, and kind of engage to that effect. So again, really appreciate you taking the time out of your day to be with us, Nancy. The most valuable asset we all have is our time, because we can't make any more of it, no matter how well we invest or studious we are with our capital. So thank you very much for taking some time out. This has been the Alternative Investing Advantage podcast. My name is Alex Perny, and we will see you on the next one.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.